Good afternoon. It is December the 6th, 2017, and I am Charles Cochran with Cochran Nanos Futures and Robbins Trading. We're putting on this webinar today introducing our wares, our software, our trading methodology to the Robbins trading community. Hopefully it will benefit those that attended it. This is an overview webinar. It'll give you the main points, and then we'll go into today's events in the markets. Most everybody starts out as an E-mini player. Most everybody that comes to us is a frustrated E-mini player, knowing that they can make money in the E-mini if they were just had access to the right kind of information. And we think we have that information that can put you on the right path with the E-mini. And when the volatility returns to the E-mini, it becomes easier to trade. I want to highlight right here, this is Michael Najjar, N-A-J-J-A-R, and you talk about a mountain chart. What he does is that he'll take a mountain range and he'll superimpose a stock index line chart on it, and this happens to be the Dow Jones for 2008 or 9. And he gives you a mountain chart, and I think they're very, very interesting. He's got a website. He's got lots of different charts for different time periods on them, and they're all very, very interesting. But throughout the industry, you hear us talk about a mountain chart, and voila, there you have it, a real mountain chart. So let's get started. We're Cochran Nanos Futures Trading. We're a firm that's dedicated to the education and training of futures traders. We have developed a methodology that works over time, that's effective in bracketed markets and effective in trending markets. Combination of the two covers the market conditions most of the time. Our methodology is based on modern statistical distributions. It's basically statistics 101, and we track the mode. We don't track the mean or the median. The mean and the median, given the old software, VisiCalc, Lotus 123, and most everybody else's software packages out there. Those are the most common studies you read about in the technical analysis books. They've been overmined. There's not much money left in the mode, in the mean or the median, but there's a lot of money in the mode, and the mode is the highest frequency in a distribution, or the event, the price in our case that has the most contracts traded. Our methodology was developed to work the capital markets, bonds, equity index futures, gold, crude oil, and the euro are the markets that we concentrate on. And those are we work on a daily basis. We spend most of the time on the E-mini, crude oil, bond, and then to gold. Our standard disclaimer: trading futures options on futures retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. The lower day trading margin, the higher the leverage, and the higher the risk. Leverage can work for you as well as against you. It magnifies gains as well as losses. Past performance is not indicative of future results. Placing of a stop or stop limit orders, which are intended to limit losses to certain amounts, may not be executed at the designated price, and market conditions may make it impossible to execute such orders. So you have to really be cognizant or aware of the risks that are involved in trading futures because of the leverage. We talked about at first that our methodology is just statistics 101. It's based on statistical distributions, and from that the Chicago Board of Trade developed what is called the market profile by taking a statistical distribution and reversing the axes and turning it on its side. Frederick Gauss, 1777 to 1855, defined the Gaussian distribution, which we know as a normal distribution. Normal distributions are important in statistics. They're often used in the natural and social sciences, medicine, to statistical inferences and come up with possible solutions for problems. The mathematical and geometric construct has made its way into the capital markets with a great deal of success. In fact, in 1986, when it was introduced to the general market, the large institutions jumped on it with both feet. So the CBOT contracts and the Forex contracts were the early adherence to the market profile. And then over time there are some players in the NYMEX, the CME, which is everything right now, in the COMEX. But first started off the grains, bonds, notes, and the foreign currencies. The classic market profile was introduced in 1985 to exchange members, the fourth quarter of 1985, and to the general public in the second quarter of 1986. I took the second class that Pete Stettlemyer ever taught to the general public in the spring of 1986. So I've got 31 years invested in the profile, and ever since I was introduced to it, I knew it was the right answer. It showed me how the markets actually did work. Now, one of the things that we see right here is we took a normal distribution and rotated the axis on it. And we have what is called a Gaussian distribution, which right here is a normal distribution. In trading, we deal with non-Gaussian distributions, which means we always have a tail. So where a normal distribution will be very, very symmetrical, like this over large populations, when you get into the futures markets, we don't have that symmetry. We always have to deal with a tail. Good resources: Stettlemyer and Markets, volume number 2, Trading with a Market Profile, and then the CBOT manual. And if you don't have that, contact us and we'd be happy to share that with you. You can download it. It's a source of great information and it'll really help you. But basically what we're dealing with is a normal distribution with a tail, and you're going to see that 67% of the volume is between the first standard deviation, so this would be the first, and then somewhere between 90 and 97.5% will be where the second distribution is, dealing with the tail. So statistical distributions in the market profile are what we're going to work with right here. And when we first started out in the profile, it was time price opportunities, TPOs they were called. That was a mouthful. Each letter traded a specific time, was tied to a particular half hour on the clock, and that's what they first looked like. From that we grew. This that you see right here was added by CQG in 1999. I had my software out there in 92. I was the first third-party vendor that CQG ever brought on in the fourth quarter of 97 and 98, and I had my software that you will see here momentarily that had volume on it. And then CQG, after I didn't work with them anymore, took the volume and put it beside the profile. But this is volume, and this would be the standard TPOs as you would normally see them. And so these were time price opportunities, were the letters with volume. This is what my software looked like, and I had this in 1992 before we had time and sales, and I simulated volume with number of price changes, and we accumulated and counted those. And our profile depiction is pretty stark. It's about as clean as you can get. I'm considered an expert in the market profile. My 3 contributions are the long-term distribution, this volume overlay right there, and what is now called the VPOC, the volume point of control. And you can see when you look at our profile right here that my depictions are pretty stark. They're pretty clean, and I like it that way. I always believe in that less is more, especially when you get to the profile. So under the classic theory, we had time price opportunity. Under modern theory, we have time price volume. And volume really is what drives the market if you think about it. I mean, why does the price go higher? There's more trades done on upticks or on buy volume. Why does the price go lower? There's more trades done on downticks or sell volume. It's pretty simple. The old were called time price opportunities. Now they're called time price volume. In the old days, we looked at one distribution. It was an isolated event. They didn't figure that it was these things could be tied together, that a move could start on Monday and end next Tuesday or something like that. So you would isolate the P's and the B's and they would work, but they would not carry through. These days we combine distributions, we get new moves out of them, and so we deal with multiple distributions. This was a perception of reality. We thought that a single day or an isolated profile was it. By combining profiles and putting them in their proper context, we move from the perception of what is to the reality of what is, and that makes a big difference. So segregation, isolation right here, unification is what we deal with modern profile theory, and it will help your trading once you understand that and you can make the distinction. Why should you know the profile? I mean, you should do it out of self-defense. Between institutions and professional traders, upwards of 70% of the volume that's done each day is done by those two groups right there. These people count on it, they lean on it, they make their trades. It captures capital flow. It shows you which way the volume is moving, which way the money is moving, into the market or out of it. So I really think that probably the major reason for understanding and having, at least having an appreciation of the profile is self-defense. The CBOT went back and back tested all the CBOT contracts from inception. They found that 30-minute time frame was the best way to look at the market. Caught almost every big move early enough to make some money on it, eliminated 90% of the noise. It shows you the market's bias and direction, and it's our contention, if you get the direction right, i.e. trade with the trend, everything else tends to fall into place. Efficient price information, it's not a mathematical overlay, it is what it is. This is reality that you're looking at. This is the distribution. It's not our idea of what a distribution should look like. It's what has actually happened. It forewarns the directional changes 30 to 40 minutes ahead of time. What do I mean by that? Right here I've got a low in I period. Then I've got a low in J and L period. Then I've got a low in M period. And then P period and Q period. And then what happens? The market rallies up like that. And so you had forewarning all the way through here that the market might be changing directions, and that's hard to get if you're reacting to the market, waiting for two lines to cross or waiting for a moving average to kick in. This does it. So right up here we have a high, the market opens, it comes up and trades. I've got a lower high, 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 and the market breaks and comes all the way down. So it's really hard to be on the wrong side of the market, i.e. trading in the wrong direction, i.e. not seeing what the market's bias is, once you understand how to read the profile. So, but I would say the first reason is self-defense. The second one is that it forewarns the directional changes before the fact, not after the fact. You can make those, and you know which way the market is most likely to trade until a new piece of news hits the market. So those are all pretty valid reasons, in my opinion, to make sure that you understand and know the profile. 3 rules, 2 patterns, 1 indicator. That's about as simple as it can get. 3, 2, 1. Less is more. Keep it simple. I come from a military flying background, and they figured out a long time with pilots, if you got more than 4 balls in the air or 4 variables involved, the time to make a decision increased exponentially. So we want to keep it as simple as we can. And so our first rule is low volume numbers are support and resistance, and especially on CBOT contracts. I mean, you can just have a resting limit sell against a low volume number with a stop plus 3 ticks outside of it. And if you're right, the market's going to come back to this high volume number. So low volume numbers are support and resistance in all markets. In CBOT contracts, they're pretty firm barriers. In CME contracts, The exchange members game them. They go for stops just outside of them. Then they bring it back in the range. So your stop has to be a little wider on a CME contract. If this number holds, you're going to go back to the high volume number, which is defined as value. And a large institution can't get the size off down here. So these numbers are very, very important to us from a retail account standpoint. This number is very, very important from an institutional standpoint. That's the only place they can execute in size. So high volume numbers are like magnets. If the low volume number holds, you are going back to that high volume number. It's just going to get there. That's just the way that it works. It's magic. We used to call it magic, but that's the way it works. And the third thing is that new moves start out of the middle. Now most people, we've been taught in the books, this is our breakout trade right here. And I'm going to buy stop into that, and I break out, and that's the start of my new move. Well, we know that about 67% of the breakout trades fail. And the reason for that is that the trading community knows where the number are. They know that there's stops right there, so it's really a maneuver gaining stops. What you find is that in auction market theory is that the market comes down until the seller is no longer willing to sell it, and it comes up until the buyer is no longer willing to buy it. And at this point, one commercial order can upset the balance. So your new move starts off this high volume number, right off that tractor, and the disruptor, or the one that upsets the equilibrium balance, is one large commercial order. Market starts to move higher. Those that had to buy chase the market up. Those that were short, protective stops keep getting triggered, and the market will come back up here and retest that one. And if we don't get through the low volume number, we're still in the trading market. We made money all the way up, as opposed to buy stopping right here and then getting stopped out for a small loss. So knowing where these numbers are and how to trade them really can have a huge impact on your bottom line. Two patterns. If the skewing in our time, price, volume distributions is a P, or shaped like a P, then the market bias is to the upside, or positive, and this is what it looks like. So what are we dealing with? AP, 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 another P. Now say, there's a B, Charlie, and the market traded higher. Yes, it did. But when we put these, remember we said the unified theory like that, we put those two together, it is a P. If I put all of these together, it is a P. And this is how you start unifying this. So this move all the way up to here did not start right there. It started right back here. And that's why you really have to pay attention to that. Where did this move start? You have to put it into context. How long might it last? So P's, retest of resistance and or higher prices. If the skewing is to the downside, you get a B-shaped pattern, and the market biases to the negative side. And right here, B. If I roll this into it, it's another B. There's a B. If I put these two together, it's B. And you say, wait a minute, Charles, the market rallied there. What's up with that? Well, you can see that it did rally, but it stopped about where it should. It tested resistance at the top of the B, and it came back down. So ideally, we've got a limit sell right here, or we're looking for a place to sell it, and then you can see the market breaks and trades lower. So we're on the right side of the market. We're looking for a place to get short to sell it, and then here's our reward right here. That's where we ring the bell, and that's where the big money comes from. So again, staying on the right side of the market will help your trading. KR1 indicator. If you're not familiar with auction market theory, prices go up until there's no more buyers. Just too expensive. I'm not going to pay that. So the market pauses, and we've got an indicator right here. That square and or the diamond tell us that the buying is dried up. So here's our first run up. That's number 1. We are expecting a retest of that high. It comes back, stops about where it should, right here. This is the mode mean area. Rallies back up, and here's our retest. And what do we see up here? We see a square and a diamond, and we've got a retest failure. So I know that the buying has dried up right there. So when I break support, I can get short on a sell stop, and the market comes down. Move, pause, I get a little rally right here. Diamond, square, the market stops, breaks that low, off to the races. So markets go up till it's too expensive to buy, and our software pops up a square or a diamond depending on what the conditions are. They measure 2 different conditions, and at that point the buying is dried up, and if I want to get short, that's the time to get short. And why would I want to get short up here? Well, it's a retest of that high right there. In fact, we even put a green dot on it and says, hey, green dot, you're retesting a previous high. The buying is dried up. Do you want to get short? So the software does a lot of the work for you. And you can see right here, this is the delta. Right in this area, you can see that the market, that color is red, it's gone sellers. This is the cumulative net buying and selling, and you can see right in this area, right down here, long liquidation, and the market does sell off. So I've got my setup up here. I've got the delta right here telling me that I've got net buying or selling in those bars, and I've got the cumulative down here telling me that I'm getting long liquidation, short covering. You put those 3 together, it's a very, very powerful approach to trading the market. It's comprehensive. Everything that you need to know is on that one screen right in front of you. It's kind of like a heads-up display when you're flying. It's all right there for you to see. So, as we discovered right there, as the markets move higher or lower, eventually the buying or selling disappears. Markets go up until the last buyer is bought. You've heard that before. Markets go down until the last seller is sold. Now you know what that means. Okay, our charts, we put a lot together. I know a lot of people work with candles. There's good information in candles. We love the wicks, the tails. We like the body. It's not as accurate as our equivolume charts are because it doesn't show you where the volume is in the bar, but it's an approximation. And what we've done, we've got these different screens for you to take a look at. And right here, you can see that I've got a double top, I've got a doji, and I've got a red bar right there. And then right down here, we are measuring the delta for 2 different volume sizes. And you can see right here the delta on both of those bars goes negative, and the market does sell. Right down here, after these 2 bars right here, the delta starts to turn up in this area. On both of them, we're measuring 2 different volume sizes, so one of them's a bar earlier than the other, and you can see that the market does try up. So what we try to do is get the entire market trading with us, but we do measure for different types of volume, and that can help your trading as you get better. Now, how do we handle this, and what is our basic screen setup? Our first one is our F1 screen, and this is where the idea comes from. So that's our idea. The second one is our F2, and this is the regular market profile chart. And this is a 30-minute time frame. This is the daily, and this is where we refine that idea, and we come up with our levels. And so we had an idea to be long or short or whatever it happens to be. It's refined over here, and this is where our buy and sell points come from. Now, most people, when they get involved in a trade, they're looking at a bar chart. And right here I've got a bar chart, so this little move is up, down, up, down, up. And so right here in these little 4 bars right here, should I stay with my trade or should I be getting out of it? And that's the issue we all face as traders. And so I'm going to show you the chart that we use to help us come to that determination. and we track volume. We're tracking this horizontal magenta or red or maybe brown bar to your eye, and you can see right there in those 4 bars that are up, down, up, down, up, down, right here you can see that the volume isn't moving. In fact, the volume is starting to move up in the distribution, because on these 2 bars the volume is a tick above the volume in those 2 bars, which was above the volume in that bar like that. It's okay to add to your length. It's okay to stay with the trade. It's okay to buy, stop into the market on this bar. All 3 of those things come. Now you're in the trade, and this is our auction chart, our F5, and you can see to the nets where the actual buying and selling is being done. So this is how idea, level, execution, track the auction process. So it's a very, very comprehensive way of looking at the market, and it keeps all you need to know right in front of you. Okay, this chart was developed for the E-mini, particularly it's our F6 screen, and it's a little bit different take on the market. This is volume, and we do measure for a certain amount of certain size volume on this chart. This is tick delta. So this is the delta of the ticks, and this was done to catch the velocity of the trading. Are the orders going to the buy or sell side? It was done to catch iceberg order entry. Most people don't want to come out there and shoot 1,000 at the market and say, I just bought 1,000 at the market, I'm getting out of the way of that order. You can execute right now 1 order at a time, 1,000 contracts in a minute. So we've figured out that we track volume less than 20 on this, and we're trying to pick up the velocity, which way are the ticks going. And this chart usually will lead the actual market turn by 2 bars. So I've got an idea, I've got a level, I've got a red bar right here. I'm up here, and you can see my red bar comes right here, and got red bar, blue bar, red bar like this. I know that I want to get short, and I can either get short at the market or I can sell stop when I break support right there. Either or is fine depending on that. And then I've got volume that kicks in with me and confirms the trade. We come down to the bottom right here, and you can see on this one that I've got a blue and I've got a blue, and we kind of waffle and go in here. So this is the first, and here's the second time it goes blue, and you can see right here is the second time it goes blue, and it's usually on this second time that it goes blue that it's okay to think in terms of being a buyer, and you can either get in at the market or you can buy stop in right there. It's up to you how you like to do it, and you got a pretty good chance that the market's going to go higher. So E-mini traders, and we use this in other markets, but it was specifically developed for the E-mini. It really does give you a leg up on timely entry if you know what you want to do before the fact, and we do. We know that we want to be buyers or sellers and where we want to do that. We bring that to the table with us on every trade. We really do track volume. We've got volume broken down to 4 different categories. So basically a 20 lot trader, a 50 lot trader, and a 100 lot trader is how we look at it. And if we can get all of these people long or short at the same time, it gives us a good trade. So the moving average turns right here, but you can see right there on that bar that all categories of volume that we measure, right there on that bar, they turn sellers. Moving average rolls over, sell stop into the market, get short at the market, up to you. Come back down, right down here in this area, first time going long, second time going long in this area, moving average turns up and it gives you a good trade. So you can really get as deep into the volume as you would like to get into it. And when we're scratching our heads wondering what to do, we take a look at this chart. This is our equivolume chart. We really like it. It's better than a candlestick chart because it's got market profile information every bar. That red area right there is the value area high. The VWAP is the green line, which we've had in this software since 2006. Market Delta built their whole marketing program on the VWAP. It's so popular now that even Goldman Sachs talks about the VWAP in stocks. That's the mode. That's the one that we like. But what we can see right here is that the mode is moving higher, and then it stalls in this area. And right here we have one of the patterns that we like, this little double top that we like quite a bit. And you can see right here on this bar that we turn sellers, so sell stopping into the market when you take out either of those two bars low. I've got sellers behind me. I can see that I had my peak buying right here. That was the peak buying on that bar. Somebody starts to liquidate their length. We do trade with an idea. We want to be long or short. This is the value area high for the entire session right here. So I should be thinking about at least getting out of my length up here, and maybe I want to go short. And so I've got this chart right here warning me of the selling. Turn sellers on this bar. I've got cumulative length coming out of the market, and lo and behold, the market breaks. So every one of these bars has market profile information into it. This is the delta, and this is the cum down here of the volume, net buying and the net selling. Very, very important charts. Can really help your trading as you learn how to use them. Okay, the market profile is a tool, and you can just see by those charts up there, everybody and their mother has a different look or take on the profile. And you can complicate it, you can color it, you can do all sorts of things, but the market profile is really three things. It's tails, range extension, and development. And it's in that development area, the congestion area, that you can come in and read the volume and see which way the market is most likely to move. So we have the market profile charts, and we have a methodology and a trading model that goes with it, and nobody else offers that. They give you the profile in their way, shape, or form, and then it's up to you to figure out how to use it. And I think we do a better job at that than anybody else out there. Okay, we've got a special Robbins trading offer right now. The first month subscription's $147.50. It's cheap. It's half price. You'll learn more about the markets in that 1 month, about who's doing what to whom and why, than you'll get out of the next year looking at reading, looking at other people, trying to follow it, figure it out yourself. We bring a lot of knowledge to the table, and it's shared with you 3 hours, at least 3 hours, 3.5, 4 hours daily. We don't want you to spend that money without being sure that you want to spend it. So we're going to give you 5 free days to our educational trading room. And to get to that, you just sign up on that link right there, and you'll get it. So our contact information is info@cnfuturestrading.com. Our telephone number is 312-361-3895, and our website is right there. Hey, we're the real deal. We will deliver. If there are no more questions, then I will go ahead and we'll stop the webinar right now. I'll leave the contact information up there.